Okay, so we should have 3 recordings: Zoom, Fathom, and Read AI. But the Read AI doesn't allow me to download. So Fathom gives me allows me to download the video as well as with like a transcript, basically. So I usually download both. If you want the transcript, I can share it with you, but I don't usually share it. Okay. So yeah. So in today's session, we will complete that other question, and then then we'll try to do another question on financial instruments that includes the fair value through OCI, the mandatorily fair value through OCI. Okay, so it's important that you can know that. So I'm just gonna go straight into it now. I'm gonna share my screen, and then we're gonna go straight into the remaining part of that question of last week. Hmm. Do you remember the question number we did? I cannot remember. Um, does anybody recall what's a question name also? Let me just go check quickly. Okay, I got it. So we did, it's all right. Okay. Okay, so you should be able to see the question paper in front of you. So remember the other 2 parts of the question. If I just go down to the required. um, So last week we did part A, which we were good. No, we didn't do that. What did we do last week? No, we did. We do this question. Yeah. So last week we did part A. Okay, and now this week we will do part B. Okay, the issue debentures, and then also we will do part C. Okay, so we will talk through those. So let's go straight into note number B. So we need to do the journal entries for note number B. So here we have note number B. Okay, so once again, when we deal with a financial instruments question, it's important to identify whether you're dealing with a financial asset or a financial liability, right? Or an equity instrument. So if you purchase a financial instrument, then that means you have a financial asset. When you issue a financial instrument, then you'd either have an equity instrument or a financial liability. Okay, so remember, you need to first identify whether you have an asset, liability, or equity. So how do you know if it's a financial asset? It's when you purchase an item. How do you know you have a financial liability or an equity instrument? It's when you issue. So in note number A, here we purchased debentures. Okay, so that makes it an investment for us. So that makes it an asset. Okay, over here, we are issuing convertible debentures. So when we issue convertible debentures, what we are doing, we're giving people a piece of paper, a contract, and they are giving us money in return. So they're giving us money in return. So we say debit bank with the money we received, and then we're going to say credit something. Okay, so that credit, because we are issuing a financial instrument, it will be a liability. or an equity instrument, or both. Okay, so just take note of that. In the in point number in point number A, we purchased, so we paid 1.4 million. So what we did there, we said credit bank 1.4 million, and then we debited something. What did we debit? We debited an asset. Which asset? A financial asset. Which financial asset? Then we classified it. Okay, so remember, you must be able to identify which one you're falling into. So if you purchase asset, if you issue equity or liability. Okay, very important. Take note of that. Then, I wanted to say, yeah, so that is the important aspect. If you are confused, if you don't remember purchase issue, look what happened. The easy thing to always look in a journal entry is the bank. Okay, so try to identify the bank transaction. Then try to identify whether it's a credit or a debit. Then you know the missing part. If you paid money, that means it must be a credit to bank. So that means the missing part of the journal is the debit. Similarly, if you received money, and that means it's debit bank. So the other part of the transaction, the missing part is the credit. So if you get stuck in a journal entry, identify the bank transaction. That's the easy part. So there'll be no marks for that, maybe just one mark. So that means the other part will be the discussion. So then when you have so if you have a debit bank, then that means you must discuss a credit. So if you're not sure what the credit is, run the different scenarios through your head. So if you received money, if you say debit bank, then we're missing a credit. So the credit, if it is an asset, that means the asset must have decreased because it's a credit to an asset. If it is a liability, that means that the liability must have increased because it's a credit to a liability. Or if it's not an asset, not a liability, then it must be equity. And then that means it's a credit to equity. So it's an increase in equity in some way or another. So if you get stuck, that is another method of identifying the journal entry. Very important to think through the journal entry. So when you process a journal entry, try to understand what you are doing. Think in terms of the actual journal entry, then think in terms of what's happening to the account, and does it make sense? To take it even further, when you process a journal entry and you try to identify whether the journal entry makes sense, then you take it even further, then you say, okay, what is the impact on the financial statements? So for example, if we look at this journal entry over here, with debit bank is increasing, with credit debentures, it's a liability, so debentures are increasing, okay? Now, what is the impact on the financial statement? So at least think through two financial statements, which is the income statement and balance sheet. Ultimately, you also want to think about the cash flow statement, but we don't have to worry about that now. You think about income statement, balance sheet. This journal entry has no impact on the income statement. So if you must impact the income statement, there should be nothing. But then for the balance sheet, what do we expect? We expect an increase to the bank, and we expect to see debentures at 350. So if you want to take it further to enhance your understanding, then you push it to that level. What is the impact on the financial statements? It's in that way it is in that way that when you do 1, 2, or 3 questions, you are then covering the full circle of possibilities that they could ask you. Remember, in management accounting and in financial management, the different scenarios is different requires is not that much. They can present it to you in different ways, but for WAC, calculate WAC. For WAC, evaluate or critically evaluate the calculation. That is typically the two types of huge questions when it comes to WAC. I mean, they can throw other questions as well, but those are the typical questions. So you kind of study those two, and then you kind of sort it. But for accounting, they can ask you for journal entries. They can ask you for the just for the calculation. They can ask you to discuss it. They can ask you to take the same scenario. What's the impact on the financial statements? To prepare the financial statements using this information. So the different types of questions is vast. So so it's very difficult to get through all types of questions if you only answer the question based on the required. So that's why when you do a question paper, think beyond the question paper. So the first step is to first answer the required. Whatever the required ask, just answer it as is. Then afterwards, spend some more time by now doing what if scenarios. What if this question was not journals, but it was just a calculation? What would I do? What if this question was not journals, but it was a discussion? How would I discuss it? What if this question did not ask for journals, but asked me to prepare the income statement and the balance sheet, or to show them the impact of this transaction on the income statement and balance sheet? So by doing that, you're taking one question, but you're asking you 3 to 4 different what-if scenarios. That is how you build your whole toolbox with one question. Then you go to the second question, you do the same thing. Go to the third question, do the same thing. And by the third question, you should have developed your understanding and the connections between the same scenario but different questions. You should be able to have connected the dots. And that is why I always recommend 3 to 5 questions, because you follow this approach, you won't be able to do 10s and 20 questions. You won't, if I must take you back to this over here. Let's go to page 70 over here. Here, page 70 has 10 questions. You'll not be following that the approach I showed you, or I said now, you wouldn't be able to do all 10 questions. You'd only be able to do certain questions. So that is why the first aspect is to choose the right question, but then just spend time doing one question thoroughly so that you can handle any question that comes your way. Because ultimately, if you're going to go through every question, you're just teaching yourself how to answer that question, but you're not giving your time to think through what you've actually learned, what if something changed, and so forth. So that is kind of important. For example, for a group question, like I always recommend students that when you do a group question and the intercompany transaction, so let's say it is parent to sub, answer the question exactly as it is, parent to sub. But when you are finished, now you must ask yourself the question, what if this question was not parent to sub, but it was sub to parent? How that then impact the income statement? How that then impact the equity statement, the balance sheet, the journals, and so forth, and the calculations. So you will see when it is parent to sub, sub to parent, there's no major changes. There's a few subtle changes, but there's no big changes, right? There's a few significant ones, but it's not a lot. But when it is a parent to associate or associate to parent, there are many significant changes. So those are the type of stuff you want to think about using one question, and then answering the different scenarios, so that you don't have to go through a million questions and never get to see the different aspects. Okay, but that's besides the point now. So let's go on to this particular question now again. So remember what we said? If you struggle with a journal, start with the easy part. Identify the bank and then solve the other part. Okay, so here they're telling us on 31 December 2019, IA issued, so it's a liability, 25, so it's either liability or equity, 25,000 convertible debentures at a coupon rate of 9% per annum. So when you see convertible debentures, then you know it's kind of like a hybrid instrument. So that means there has to be a liability and an equity component. They say that the debentures were issued at fair value, with a face value of 14 Rand per debenture. So the debentures were issued at fair value with a face value of 14 Rand per debenture. The maturity date of the debenture is 31 December 2023. So at this stage, we can work it out. So that was issued on 31 December 2019. So 2020, 2021, 2022, 2023. So that is 4 years. Each debenture is convertible at the option of the holder into three ordinary shares, okay? So very important. Um, the question when you deal with a convertible instrument, you must always identify who has the option to convert. Okay, if it is at the option of the holder, so that means it's the investor, the other party have the option, not we, the other party have the option, then that means we have to raise a liability. Okay, if it is at the option of the if it is at the option of the company, then it depends. Sometimes you will raise a liability, sometimes you will not. It depends at the time whether the company believes it will issue a liability. Let me say again this. If it is at the option of the holder, you will have a liability and an equity instrument. Okay. If it is at the option of the company, it depends whether the company is going to expect to issue equity instruments or not. So just take note of that. So it's very important to identify who has the option. If they don't give you the option, if they don't tell you who has the option to to make the decision, then you always split it between an equity and a liability component. Okay, so they say if the debentures are not converted, they will be settled in cash at face value. Okay, so if it's not converted, we'll have a full liability. Um, a market-related interest rate on 31 December 2019 for similar debentures without a conversion right is 14 Rand per debenture. The transaction cost incurred and paid amounted to 10,000 Rand. Okay, so let's have a look at this. Can I ask you to take like just 3 minutes? It's now 8 minutes, 2 minutes past eight. Just take 2 minutes with yourself to tell me what you think you would have done at 31 December 2019. Just 3 minutes. Okay. Let's get back. So do you got anyone wanna tell me how they would recognize this transaction at 31 December 2019? You want to take a try? Remember, don't be afraid. Even if you get it wrong, that is not the point of it is not to see who knows it, who doesn't know it. But it's when so I can see the thinking, and that will help me to help you. So who wanna go first? You know, I was gonna take a try. So who want to volunteer to go first? Alicia, Madania, Shaheen, who wanna go first?
Okay, I'll try.
Yeah.
So, I'm looking at the transaction cost. You would capitalize the transaction cost.
Say again. Sorry,
You would
I couldn't hear. Yeah.
you would capitalize the transaction cost
Okay.
of 10,000. That's all I actually saw at the moment. So I thought you capitalized that first because I saw the journal entry of 350, and
Yeah.
they haven't actually taken that into account. So you'd have to do that journal entry first.
Okay. Yeah. So we'll capitalize it. Anything else that you do?
I haven't thought of the rest yet. I've just looked at the
Yeah.
capitalization
Okay.
below.
So we'll definitely capitalize it. Yes. Okay. Anyone else pick up anything else? Madania, Shaheen, yes, no. Madania, yeah.
Hi, it's Marinea.
Yeah.
So once I read it, like the way you explained to me the issued and the purchases, really, I didn't think about it like that before. Like, so this is the first time I actually thought of that, and it actually makes sense. I would always sit in exams and think like, what am I debiting? What am I crediting? So thank you for that. And also, I think the first thing also with, because they're giving you the percentage per annum, which is the 9%,
Yeah.
and we know that we need to work out basically the PMT for the year as well. So what I did was I worked out the 25,000 times the 9% times the face value. I'm not sure if it's correct.
Yeah.
Just to get the PMT basically for the year. And that is where I literally stopped. And then I basically didn't understand the way of this 350. But if I divide that by the 14, then I'm getting the 25,000. So I'm assuming they're saying the convertible 25,000 that is in issue times the 14 rand, which is the face value.
Yeah. Which is also the fair.
Okay.
So the face value.
Oh,
It's happened to be
okay.
in this scenario happens to be both. Okay.
Okay.
It's not
Okay.
always both. Yeah.
Okay.
Shaheen, anything from your side?
So I don't know if I'm correct, but the first part I thought about maybe it's equity because it's three ordinary shares. And then at the bottom part, when they said that they had to pay for those debentures, I thought maybe about you paying your liability. So I don't know if I thought in the right way, because you say it either can be a liability and equity. It depends on the situation.
Yeah. Okay. So yeah, in this question, whenever you have a convertible instrument, right? Whenever you have a convertible instrument, at initial recognition, we're going to recognize equity part and a liability part. So this journal entry over here, that is 100% correct. That's 100% correct. This is not 100% correct. Okay, this needs to be split between debentures fair value and debentures equity component. Okay, so we need to split that 350 between a liability component and an equity component. So whenever there's a convertible debenture into shares, we need to have two parts. Okay, so let's show how we would get this. So let's us try to see how we'd get this. I just want to open up Excel or Google Sheets. Where am I now? Okay, so the second thing I want to identify, so as Madania discussed regarding the payment, okay, what's important to take note is where is this now? I'm really trying to find my Google Drive. No. Let me just use my other drive so long. I'll just use Excel so long. So let me just share this quickly. So as Madalena discussed regarding the payment, right? So what's important to take note over there. So when you're dealing with accounting, one of the very first things you must identify is what period you're working with. Okay, so our financial year was 31 December 2019. So we wanted 1 Jan 2019 to 31 December 2019. The part A of the required asks us to look at the journal entries for 31 for the financial year ended 31 December 2019. So for this transaction B, that the initial recognition happened on 31 December 2019. So that would be the only aspect relating to this transaction for the 2019 financial year. The payment aspects, that will only happen from 2020 onwards. Okay, so just take note of that you identify the period you're working with and what period the required is asking you to tackle. Okay, so it's very important. So what I usually do, or what I usually recommend, once you have identified your financial year, write it down somewhere. Don't keep it in your head. There's unnecessary baggage in you on your brain. Okay. So in an exam, don't try to remember it. Just write it one side that you can see it easily and quickly. Don't store it in your brain. Okay, that's unnecessary workload on your brain in an exam situation. So we were dealing with 31 December 2019. So the only aspect we need to deal with is initial recognition. They didn't tell us do initial recognition. They told us deal with part B for 31 December 2019. So the fact that the transaction only happened on 31 December 2019, that means we're only dealing with initial recognition. The payment aspects falls into the category of subsequent measurement, but subsequent measurement only happens from 2020 onwards. Okay, so just take note of that. So on 31 December 2019, we're gonna recognize, whatever we paid. Okay, so I mean, whatever we issued, so whatever money we received. So we received bank. You can see Excel, right? SFP, and here we're going to have debit and credit. Okay. So here we're gonna have debit and credit. So we received money of 350. So to work out what the fair value is, we will say we received 350 divided by 25,000 shares. So you can see that the fair value is equal to the face value. So it just happened that the face value and the fair value is the same. Okay, so we couldn't assume that the fair value was the same. We needed to work it out. So there I worked it out. We received 350 for 25,000 debentures. So therefore, the fair value happens to be 14 Rand, which is the same as the face value. Now, because it's convertible debentures, we need to split this between an equity component and a liability component. Okay. So we need to split this between an equity component and then also a equity component. Okay, so there we go. So now we need to work it out. Okay, so I'm going to do my workings over here.